But here's where I'm going to start with our changes and impairments video. So we talked in class about how this page was primarily just informational, like that might be kind of a multiple choice question if I was thinking about how deeply do I need to know this. What you really need to remember is that management can change categories. Remember these classifications, these are all debt securities. You should recognize held to maturity, available for sale and trading. Those are all debt securities. And the point here is that management makes those classifications based on management's intent, but management could change mind, right? Change their intent. And so if the intent changes, then you would change the category. So transfer from whatever category you were in to whatever category makes the most sense. The basic rule is when you make that change, you do this. You do step one, you bring the debt security to fair value. That's step one. And step two is really simple. Two is that you transfer the balance. Okay, let's put this a different way. That you close out existing debt investment accounts because they would be under your old category. And move to new debt investment accounts. Okay, so now whether you close it, I mean, obviously you wouldn't close it if you still had some investments in there. So this is the idea that, you're totally getting out of one. But that's what you do. So this chart is basically showing you where the unrealized gains that you would have to recognize when you brought something to fair value, where would they go? Right, so that is what's happening in this chart. So I will leave that for you to look at. All right, and we then moved out of the realm of the changes in the debt securities, and we started looking at this change in the equity securities. And remember, with the equity securities, you have this differentiation between how many shares you own. So if you have 10% interest, then you're in what we call the passive equity section. And in your textbook, that's called the fair value, okay, reported through income. I think they have some weird phrase for that, but that's the passive investments, okay, where you bring everything to fair value and you take those gains and losses to the income statement. Remember, that's up to 20%. And then we talked about the category between 20 and 50% would be the equity method. So this particular problem is a situation where you had a 10% interest and we buy 20% more, which obviously throws us in combination above 20%. So we're moving from a passive equity investment to an equity method investment. So in that very first question, it says, which method of accounting is appropriate for this investment after we make this additional purchase? And your answer would be equity method, because once we buy an additional 20%, our total ownership percentage is going to be 30%, and that's within the window of 20 to 50, so we have to do an equity method is how we would account for that. It's going to just hop there. Okay, so then I talked about number 2. Fortunately for all of us, GAAP now just requires us to use prospective treatment for the change, which means we just go forward with the new method after we bring that investment to fair value, like all those changes we just talked about in the prior slide. Okay, so step 1 is going to be bringing this asset to fair value, the investment to fair value. And then step 2, you can kind of look ahead and see, it's down here, number 3 was step 1, bring it to fair value. Step 2, close out the existing accounts and set up a new account. And then we're going to record that additional investment that we made at the very end. So first question here is, what is the fair value of the existing investment on March 1st? So the existing investment, what I'm talking about there is the $3 million investment. That's the value. Okay, there was a $2 million investment account and a $1 million fair value account. So that goes together for $3 million, and that was for a 10% interest. So what question 2 is asking you is, what is the fair value of that 10% interest on March the 1st? Well, I don't tell you explicitly what that is, but I do give you information that you can use to figure it out. Okay, then that information is this. I do show you what 20% is worth on March 1st because Ronald Company purchased 20% for $6.3 million. So that $6.3 million is the fair value of 20% of this company. All right, so there's a couple of ways you could get to the fair value of 10% of the company. So I'm just going to talk about 2 of them here real quick. This is for number 2, okay? So I could say, all right, $6.3 million is 20% of the 100% of, or 20% of X, I'm just going to call it, okay, make it an algebra problem, where X is the value of the whole company. All right? So then if I solve for X, and get X equals 31,500,000. Okay, so how did I do that? I basically divided 6.3 million by 20%. And that is going to give me 31,500,000, right? So now the problem doesn't ask you for that number. It asks you for 10% of X. And so if X is 31,500,000, then 10% is going to equal 3,150,000. Right? So that's just 10% of that number. 10% gives me this number, okay? So this is the answer, 3,150,000. You know, the other way that you could have gotten there, you might, when I show you this, you might go, oh, okay, that's a lot easier. Let's see. Trying to figure out how to get to it. Anyway, the other way to get to it, which would be, I think, easier, would be that you take the 6.3 million that you paid for 20%, and you recognize the fact that 10% is half of 20%, so you just cut this amount in half, and you'd get 3,150,000. All right, so then I got to do some journal entries to finish this out. So I'm going to move this information up here out of the way a little bit. And so we're going to be looking at the journal entries to bring that existing investment to 3,150,000. Well, to do that, you need to think about what is it recorded at currently. So let's draw some T accounts and make sure we understand what's going on T account wise. Oh, I don't want that to be that color. It's not a good T account color. Let's make them. All right, so one of these accounts is going to be the investment. I'm going to call it passive equity. And the other one is going to be the fair value adjustment. Okay, remember that's a permanent account, fair value adjustment account is. All right, so the Investment passive equity from the problem. We're given a value there of 2 million, sorry. That is the value that we started with. And fair value adjustment has a balance of 1 million. That is how we get to the balance of 3 million that we have for value. And then we just now determined that really at this point it should be worth 3,150,000. So I obviously need to do a journal entry, and that journal entry needs to increase the fair value adjustment account by 150. So here's what my journal entry is going to look like to do that. I'm going to debit, so that's assets going up. I'm going to debit the fair value adjustment account. By 150. Oop, I need to make that whole thing big enough. And I'm going to credit unrealized gain. It goes to the income statement because we're talking about investment securities. Equity securities. You're like, the whole chapter is investments. Equity securities, and equity securities are always going through the income statement, right? Nothing goes to OACI except for those available for sale debt securities. All right, so that would be my first entry. So here in my T account, that's going to make this number go up. Move it over there because it's not in the right place. There we go. Okay, so now I have a balance here of, put these all together, 2 million plus 1 million plus 150. I got 3,150,000, which is exactly what we said we needed. So that was the answer to number 3, prepare a journal entry. Now we're looking at number 4, prepare an entry that closes out both the existing investment account and records a new investment account. All right, so I'm going to need another T account. I'm actually not going to write out this journal entry because you are definitely able to do this one yourself. So rather than write this one out, I'm going to just do a little bit of editing. Investment equity method. And I'm just going to talk about the T accounts. All right, so I'm just going to talk about what's going to happen with these T accounts. So I am going to need to credit this account by 2 million. Right, to get rid of that, I'm going to need to credit the fair value adjustment account. By the whole balance. Okay, now you can see I've wiped those two accounts out, right? Credit 2 million, credit 1,150,000. The other side of the entry, guess where it's going to go? Dun, dun. It's going to go right here. 3,150,000. There you go. So that I showed you number 4 is a journal entry. I just showed you in the T accounts what it looks like. Okay, it would have a debit to investment equity method, and it would have a credit to investment passive equity, and it would have a credit to fair value adjustment for 1,150,000. And that would zero those accounts out and leave me with just the new equity method investment. All right, so now we're at number 5. Record the additional investment. Again, I'm not going to write out the journal entry because I know you can write out the journal entry without me. This is where we're just going to record the additional $6,300,000. And so that definitely would be a debit to the investment account and a credit to cash. So, and then I ask you what's the balance in the investment account at the end. So that is just summing up this balance, and it is $9,450 would be the ending balance. And I told you in class, one way that you can confirm whether you did this right is to think about the fact that back at the very beginning of the problem, it's all up there. The very beginning of the problem, we see that we had 10%, we bought 20%. So altogether, we should own 30% of this company. We said that 100% of the company was worth $3,031,500,000. If I take 30% of this number, it better be this number, and it is. Go ahead and test that yourself. 31,500,000 times 30%. You're going to get 9,450,000, which makes sense. We bought 20% of the company. GAAP says we have to record it at fair value, so it should equal the total 30%. So there's that one. And we have some quiz questions that just going to reinforce. Here's a question. If we sell off half of the investment, will we have to change accounting methods? And you should say definitely we would have to change back, okay? Anytime we jump over that 20% threshold, we have to change accounting.